Today we bring you an introduction to American life insurance. Term life insurance or term insurance is a life insurance product that provides coverage for a period of time. After this insurance expires, the coverage is no longer guaranteed at the previous rate. To provide cover at this point, the customer must either give up the insurance or be reassessed by the insurer at a new premium price rate or other terms for further insurance. If the insured person dies within this period, the insurance company pays a death benefit to the beneficiary. Term insurance emerged around 1850. It is the oldest life insurance product in history. It is also the basis and prototype for all types of life insurance products in the modern world. Term life insurance prices and premiums. Term insurance is the cheapest form of cover. It is the cheapest form of cover and product available. For a $500,000 term insurance policy at age 35, the base premium is usually around $60 a month. Advantages and disadvantages of term. Cheapest premiums, as low as $20 a month. Single feature. Coverage is limited by statute of limitations. Death benefit available. Cost of renewal and renewal conditions increase dramatically. Whole life insurance, often referred to as savings insurance. It is a type of life insurance policy. It is a life insurance policy contract. It provides protection for the life of the policyholder. Whole life emerged in the 1950s, introduced the basic concept of cash value, which laid the foundations for the subsequent development of various types of insurance products. Specifically, the premiums you pay after paying a fixed cost of insurance. The remainder is converted into cash value. The insurance company pays regular dividends based on the company's profitability. As time goes on, the cash value of the insurance policy increases. The insurance company usually promises a guaranteed rate of return. For example, a guaranteed return of 4% per annum is promised on the cash value portion of the policy. Whole life savings insurance, a continuation of term insurance, meets a new consumer need. It fills some of the gaps in term insurance. Many savings and with-profits insurance policies in Asia and Hong Kong. Whole life insurance is a type of insurance that is available in many parts of Asia and Hong Kong. Whole life insurance is significantly more expensive and has higher premiums than the term product. Depending on the age of the policy and the guaranteed rate of return, whole life policies can be calculated as a whole life premium. Therefore, the basic cost of this policy is fixed. It does not increase with age. Premiums are usually payable for the lifetime of the policyholder. It can also be designed according to different design options. In 10 years, 20 years or at age 65. Apply for a $500,000 whole life savings policy at age 35. The basic monthly premium is usually around $1,000. Pros and cons of whole life savings insurance. Lifetime protection and claims. High premiums. Cash value feature. Compulsory payment of insurance. Inflexible cash value. Fixed premiums where market conditions are good. Lower returns. Return on protection. Tax incentives. Universal life. A flexible whole life insurance policy. Universal life or universal life insurance, often abbreviated as UL insurance. It is a whole life insurance product. It was introduced in the 1980s. Universal life insurance was sold mainly in the United States, fulfilled a strong consumer need for financial flexibility at the time. It filled some of the gaps in whole life savings and participating insurance policies. Customers could deposit cash into the policy. Any excess of premiums over the current cost of insurance will be credited to the cash value portion of the policy. The insurance company operates the funds. The policyholder receives a dividend return from the insurance company. The amount of this return yield is determined by the insurer. If this rate of return is linked to a stock, bonds or financial indices, this results in a type of UL or a UL insurance that we will describe later, whereas for the traditional universal life insurance, the insurer will usually offer a minimum guaranteed rate of return to the policyholder. If the insurer's annual market rate of return is greater than the guaranteed rate of return, the policyholder receives a corresponding dividend. If the customer does not pay the premium, the insurance company deducts the premiums from the cash value. Prices and premiums of universal life. Universal life has flexible prices and premiums. This type of insurance and its derivatives work well in an irrevocable life insurance trust. As a general rule, for the same amount of cover, universal life's base premium may be 1/2 to 1/3 that of a whole life savings type insurance policy. Advantages and disadvantages of universal life. Universal life, lifetime protection and claims uncertainty of return. Cash value feature complexity due to flexibility. Flexible premiums, minimum return and market rate of return. Tax incentives, guaranteed whole life insurance. This is known as guaranteed universal life for life. GUL insurance is a development of universal life. Its main function is to provide lifetime protection at a relatively low premium. It provides lifelong protection to the policyholder of all the universal insurance products. GUL insurance is the only type of insurance where the premiums are paid in accordance with an agreed payment plan. There is no risk of discontinuation of cover. An example, if a client buys a GUL with a sum insured of $1 million, chooses to pay off over 10 years, $20,000 in annual premiums are paid. Then as long as the client pays the premiums normally, whether the market plunges or rises, no matter when the policyholder dies, his beneficiaries will receive a death benefit of $1 million. Prices and premiums of GUL insurance. The price and premium of GUL insurance is relatively cheap. It is the lowest premium of all. The lowest premiums for whole life insurance. Reviewed by Life Insurance Guide USA, the price of GUL insurance policies in the US market, the most competitive of any whole life insurance policy in the world. Most competitive. Advantages and disadvantages of GUL insurance. Lifetime protection and claims only protection function. No risk of breakage single cash value function. Low cost whole life cover. Tax incentives. Investment insurance. Variable universal life. VUL insurance for short, often referred to as investment universal life insurance. VUL insurance is an evolution of universal life. It combines the protection function of universal life with the investment account function of the stock market. VUL insurance differs from universal life in that the customer can choose between the investment objects offered by the insurance company, use the cash value to select different investment objects, and thus receive a corresponding investment return. When the market goes up, there is no limit to the amount that can be invested. In good market conditions, the cash value returns can fully cover the annual cost of the policy cover, but the other side of the coin is that investments are not guaranteed. If the cash value account loses too much money in the financial markets, then the policyholder will have to add more cash to keep the policy in force. This is why the product is so important to the policyholder. The broker's own level of investment and risk tolerance is required. Prices and premiums for VUL insurance. Prices and premiums for VUL insurance are highly flexible. If only the cost component of the policy and rider is maintained, the cost price of VUL insurance is about the same as a universal life product. However, the actual investment in VUL insurance depends on the policyholder's objectives. As VUL insurance offers the flexibility of universal insurance, it also has an investment function. The policyholder can put any amount of money into the policy from $0 up to the IS limit. Advantages and disadvantages of VUL insurance. Lifetime protection and claims taking high market risk. Directly linked to the market, no guaranteed cover. Uncapped rate of return, higher investment management fees. Tax incentives. Indexed insurance, often referred to as indexed life insurance. IUL insurance is also a derivative of universal life. It was introduced in 1997. It is a universal life insurance policy that covers the whole life. IUL insurance has all the basic features and flexibility of universal life insurance. The important difference is that the cash value component of IUL is directly linked to several major market indices: S&P 500 in the US, Hang Seng in Hong Kong, 30DAX in Germany, etc. The investment returns of IUL insurance are linked to the movements of these indices, provides a guaranteed cash value cover, and a return cap. If the index falls, the policyholder's cash value is protected up to 0% of the return. If the index rises, the policyholder receives the corresponding return. Insurers have capped their IUL policies with an annual yield strategy. The market's published cap for 2018 is typically 11% minus 12%. Prices and premiums for IUL insurance. IUL insurance also offers great flexibility in terms of price and premiums. If only the underlying cost of insurance component of the policy and riders is maintained, the cost price of IUL insurance are usually similar to those of universal life insurance policies. Generally speaking, for the same sum insured, for a $500,000 IUL policy at age 35, the basic monthly premium is usually around $400. As with full insurance, the actual cost of IUL premiums. IUL insurance is also currently used in the U.S. individual market for tax-free retirement planning and child education fund planning. Advantages and disadvantages of IUL insurance. Lifetime protection and claims uncertainty in the rate of return. Capital protection provides a minimum return. Investment returns are capped. Maximum premium flexibility. Tax incentives. In summary, from term life insurance, which only offered a death benefit, to today's IUL index policies offering a wide range of rider. In 100 years, the US market has seen a constant evolution of life insurance. New products have been introduced. In general, different insurance brands tend to specialize in different types of insurance. For the same type of life insurance policy, even under the same company brand, they may have different product lines to suit the different needs of the market. We hope that consumers will be able to tailor their insurance to their own circumstances and needs, with a professional broker or financial advisor, to determine which type of life insurance and corresponding products they need.